Today we're explaining cap rates. This is a commonly used metric for real estate investors. The idea is to estimate your potential return on an investment. Cap rate is short for capitalization rate, and it's really representing yearly return expressed as a percentage. So you think about any other type of investment like mutual funds, you want a greater rate of return. The formula for cap rate is as follows. It is net operating income divided by current fair market value, or maybe let's call it the price you are contemplating offering. So if you were to use a cap rate calculator online, you can actually play with the price to help you figure out an offer amount based on the returns you need. Professional investors are usually good negotiators, and that's actually a great tactic. You know, they'll say, I can only offer this price because I need to get this rate of return on my investment. So first, we need to find the net operating income. For this example, let's say we have a small one-bedroom condo in Brookline. Current fair market value is $450,000. So to get the net operating income, it is annual gross income minus operating expenses. So in this hypothetical Brookline one bed, the rent you could get for it is $2,500 a month times 12, because we're using annual figures, right? So annual rent, annual expenses. $2,500 a month times 12 is $30,000. That's our annual gross income. Now we need to figure out operating expenses. So condo fees, insurance, taxes. Do you have to pay property management fees? For a one-bedroom condo, I'd plan on setting aside at least $100 a month attributed to general maintenance and repairs. As you're budgeting this out, you're building in those expenses. Of course, you want to be as accurate as possible. You don't want to underestimate your expenses. But if you're way overestimating, you might not be able to see the deal for what it is. That's why metrics are good. They are unemotional. Numbers don't lie. For this hypothetical Brookline one bedroom, I've estimated expenses to be about $700 a month, which translates to $8,400 a year, which translates to a 28% expense ratio. So 28% of the annual $30,000 goes toward expenses. Let that sink in, and let's keep going. So $30,000 minus $8,400 is $21,600. This is our NOI, net operating income. We found it. And if you have an interest in real estate investing, and really, why wouldn't you? The best way to get started, in my opinion, is to analyze deals this way and calculating cap rate, like analyze one deal a day, really get into it, get an idea of the market price and the real expenses you're up against. This is how you learn to recognize a good deal. It takes practice. So we found the net operating income. It's $21,600. That all but finishes the equation, right? So remember the original cap rate equation here. We divide our net operating income, $21,600, by the price, $450,000. Calculator will show you 0.048, but we represent cap rate as a percentage, so we move the decimal point over 2 spaces. That gives us a 4.8% cap rate. That's pretty average for Brookline right now, in line with the market anyway. That's right there. And in an example where you have upfront repairs to make, let's say you're doing a $30,000 kitchen renovation as soon as you close and before you rent it out, you should take that $30,000 and tack it on to the price, right? Instead of factoring out into your expenses. So in the one-bedroom condo hypothetical, you're now dividing by $480,000. Because that's your full upfront investment, $480,000. I'd say around Boston and the South Shore, you simply want the cap rate to be higher. Most of the deals that I'm analyzing on a regular basis are 4.5 to 5 cap range, where 6 or 7 cap would show better estimated returns, right? They would appear to be better deals. Around Boston right now, I highly doubt you'll be finding, at least on the open market, anything higher than like a 7 cap, right? There are so many eyes on the market right now. But in your travels, if you do find a deal where you run the numbers and the numbers look better than something like a 7 cap, or even in that range, you should call me, because you may want to consider buying that property depending on other factors. Separate issue, cap rate can also be seen as a measurement of risk. So around Boston, we have low cap rates because it's a major metropolitan area where rental demand seems to stay high. When you stretch out into more rural areas, less desirable real estate markets, local economies that are less diverse, there's more risk for turning an investment property into a performing asset. So now you're talking more about the macroeconomics of real estate. All I'm saying is, cap rates for me, at least around here, they're less of a risk assessment. They're more about showing a metric for predicted rate of return. Notice how we don't even mention interest rates or financing in any of this. It's not relevant to the cap rate. Cap rate is only concerned with judging the property on its merits as an investment. So it's not concerned with debt or the cost of debt. The exclusion of debt is exactly why cap rate is so helpful. You can use it property to property and compare them without any other variables. The way I use this tool is I figure out the market rent. Obviously that's a huge thing and we kind of flew through that. Estimate expenses, and then I say, okay, if I'm going to buy an investment property, I've been following the market, I've been analyzing my deals. I know that the average right now is about a 4.5% cap rate. I need to see more of like a 6% cap rate if I'm going to buy an investment property. And you can pop online and you can use those easy cap rate calculators. They might help you to determine that price and hit that 6% cap rate mark that you're looking for. I'm not saying math is fun, but money is fun, and passive income is really fun. Thanks for watching.